what are those 5 common mistakes what people make when selecting a mutual funds so that you can be aware of them and avoid them in the future. Hello everyone, I am your wealth wisher Pruthviravindranath. Welcome back to my channel. Today we are discussing about a topic which is incredibly important if you are investing in mutual funds. The topic is how not to invest in mutual funds. Now, mutual funds has a great way to invest your money and grow your wealth. But there are some common mistakes what people make when investing in mutual funds. And I would like you not to repeat those mistakes. So today in this video, let us understand 5 common mistakes what people make and how you can be aware of them and thereby you can avoid them. Imagine you are planning a road trip. Would you choose a vehicle without considering factors like mileage, safety, comfort, etc.? Similarly, investing in mutual funds is a journey and we need to make sure that we tick the right boxes before selecting a mutual fund rather than picking them blindly. So let us understand what are those 5 common mistakes what people make when selecting a mutual funds so that you can be aware of them and avoid them in the future. Let us discuss the first mistake what many investors do, and that is chasing past performance and ranking. Many investors look at mutual funds on how fantastically they have done in the previous year and check the current ranking in mutual fund websites, and they jump the guns and invest in that particular mutual funds. But the problem here is the past performance of the mutual fund is not the guarantee for the future returns. In fact, every mutual fund have their own ups and downs, and you might be investing in that particular mutual fund at a very high point. So we need to understand and focus on funds fundamentals rather than just chasing the past performance. The fund's fundamentals might be who is the fund manager of that particular mutual fund, what is his complete experience, what is his experience in managing that particular mutual fund, what is the investment philosophy what they follow, whether they follow a buy and hold strategy, whether they churn the portfolio quite often. We need to understand a lot of basic things about a fund rather than just chasing performance. Yes, seeing the past performance is important, but understanding and focusing on funds fundamentals is more important than just chasing performance. Mistake number 2 is not diversifying enough. What is diversification? Diversification is all about spreading your investments to different asset classes so that you can reduce the risk of the portfolio. But many investors invest in a particular mutual fund or a particular category like only small cap, only mid cap, only large cap, or invest in particular sectors like only IT, only pharma sector, only bank sector. And what if your fund underperforms? What if your category underperforms? What if your sector underperforms? Your complete investment portfolio will be under risk. So it's always better to diversify your portfolio across mutual funds, across categories and across sectors so that you can preserve your capital first and next you can think about capital growth. On the flip side, mistake number 3 is too much diversification. Yes, diversification is needed, but if you go overboard, you might ruin the return potential and it becomes difficult for an individual to track his mutual funds. There are many investors who invest in 20 funds, 30 funds, having a very small SIP of 2K, 3K, and when we investigate the portfolio, they have the majority of the portfolio in one category or two categories max. Like we have come across some investors who invest in 7, 8 funds in a large cap category. And if you check the overlapping factor of all the 7 funds, it will be more than 70%. That means all the funds are investing in common stocks of the stock market. What is a large cap fund? Basically, it invests in top 100 companies of stock market. So there are only 100 companies. Each fund will be investing in the same company. So investing in different funds doesn't mean that you're diversifying your portfolio. Make sure you strike a right balance of diversification by diversifying in different asset classes rather than diversifying into different mutual funds. If you are diversifying in different mutual funds, you might be diluting your return potential, and also you will be paying unnecessary fees. So it's very important to strike a right balance of diversification and manage your portfolio efficiently. Mistake number 4 is following the crowd. In behavioral economics, they say this as the herd mentality. Just because everyone are talking about a particular mutual fund doesn't mean it is right for you. Investing in a hot tip or what's trending might lead to poor decision making. Remember, your financial goals, your financial objectives, your risk tolerance, your risk appetite are very unique to you. So make sure you select a mutual fund which aligns with your financial objectives rather than following the crowd blindly. And lastly, mistake number 5, frequent trading and switching. There are many investors who treat mutual funds like stocks, and they do frequent buying and selling of mutual funds based on short term market movements. And this can result in high transaction costs and high capital gain taxes. Instead, focus on your financial plan, focus on your those long-term financial goals, and stick to a investment strategy. Don't let short-term market movements decide your investment strategy and decisions. So there you have it, folks. 5 common mistakes to avoid when selecting and investing in mutual funds. Make sure your mutual fund selection and investment strategy is a well thought out long-term strategy which aligns with your financial goals and risk tolerance. If you find this video useful, please hit the like button, share with your friends and family members, and subscribe to my channel for more information on mutual funds, investing in personal finance. And don't forget to hit the bell icon so that you will never miss an update from my end. So thanks for watching this video. Until next time, happy investing.